Bloomberg Audio Studios. Podcasts, radio, news.
Hatzius and the team over at Goldman Sachs falling in line with the broad consensus, expecting 3 Fed rate cuts this year. Hatzius writing this: inflation has been firmer in recent months, but we think it is still on track to fall enough by the June meeting for a first cut. This has become less obvious, though, and our inflation path for the rest of the year is now at a range where small surprises could have large consequences. Jan, I'm pleased to say, is with us in the studio in New York. Jan, good morning to you.
Great to be here.
Fantastic to catch up with you, sir. I remember the outlook to start this year, and we talked about it a lot on this program. The hard part was over. It's almost easy from here. Do you still think that's the case based on the data we've had so far this year?
Yeah, it's more of a question because of the stronger inflation numbers. But I think if you look at the trends, we're still on track to get down to the 2.4% range or so for core PCE inflation by the fourth quarter. Now, at the start of the year, we thought that was going to be 2.2%. So that's been, a little bit higher. We've basically gone back to the forecast that we had last fall. But 2.4% is still, pretty good progress. And by 2025, I think we'll be at 2. If you look at the drivers of inflation, whether it's on the goods side or on the rent side or in the labor market, I think the trends there still look encouraging. But of course, the prints have been higher, so there's more of a debate about it. And the Fed is going to be responsive to kind of near-term surprises.
Well, let's talk about how responsive they might be today. As we know, clear and obvious risk factor is in the dot plot, whether that median dot shifts from 3 cuts, say, to 2. And as we all know, it only takes 2 officials to move in that direction. Do you think that's something that happens today? Is that a base case in today's meeting?
It's not a base case for me, but it certainly is a possibility because not that much has to change in terms of the projections. If you go back to 2 weeks ago when Chair Powell testified in Congress, he said they were, pretty close to having enough confidence. So that sounded like, a cut no later than June. If you take the statements there, we've had higher inflation numbers in the past week. So the question is, has that changed his view? My expectation is no, but we'll find out at 2 p.m.
All things being equal, it seems to have changed your view on the margins. You shifted down to 3 rate cuts expected for this year from 4 earlier in a report in the past couple of weeks. And you said this line that John noted: small surprises could have large consequences. What do you mean?
Well, if you have a few additional tenths of inflation by the end of the year, even if it doesn't really change the overall trend, 2024 is still lower than 2023, but they would deliver less cuts. So in that sense, I think it'd be a continuation of what we've seen in the last several months, where in the early part of the year, with an expectation of inflation coming down to very close to 2, I think they would have done more. But now it seems like the December dot plot and the December inflation forecast looks pretty reasonable to us.
It seems like people are split on their views based on whether they think that the neutral rate has shifted materially or not. You believe that the neutral rate is still going to be around your previous projections of 3.25% to 3.5%. How do you push back against people who say it's actually 4% or higher, like El Salinas of RBC Capital?
I think we don't know, and I wouldn't push back very hard because the confidence interval around any of these estimates is quite high. 4%, though, is still well south of 5 3/8. And I am pretty confident that at current levels, we're in restrictive territory by a significant amount. But whether the right number, is 4 or 3.5 or 3, that's harder to know. I do think that the FOMC projection, 2.5%, if you take the median, that looks pretty stale. And I think that is going to drift up over time, probably by a little bit today, although we've been waiting for this for a while, and so far it hasn't happened, at least as far as the median is concerned.
You're a precise man and very careful with your words. When you say we're in restrictive and significantly so, what guides that? Where does that come from?
I think all models of neutral rates, and they're all pretty imprecise. This is not precise. There are many different models. Each of them has a significant amount of error, but you're going to be hard-pressed finding a model that says 3% plus on the real rate on the real funds rate is neutral. So it's really guided by a variety of different models, some developed at the Fed, some developed elsewhere, that say right now we're outside that range of uncertainty.
Can I ask you this question then? If I was a first-year intern at Goldman Sachs, I'd create a model really quickly and I'd say, Jan, unemployment's at the 4%, equities are at all-time highs and credit spreads are super tight. Why is that a bad model to sit here and say that maybe we're not that restrictive at all?
Well, so there's kind of short run and long run. So I don't think that the current level is very problematic in terms of near-term growth. And as you know, our forecast on growth is well above the consensus and continues to be. But over time, once the kind of short-term moves in financial conditions, short-term moves in fiscal policy and other forces play themselves out, I think it's pretty clear that the current level is above normal kind of neutral levels. And so over the medium term, it's very likely that we will see declines in rates, but the time path is going to be guided by the data.
So you don't think it'll be important for Jay Powell to push back against some of the record highs on stocks and some of the tightening in credit spreads?
Well, he would never comment on near-term market moves, of course.
Right.
So you say that, but actually I remember that meeting where that journalist, and it was an honest mistake, said to Powell that markets were rallying. And I remember his response to it in the news conference, and we all talked, I think it was Jim Bianco of Bianco Research that called it Powell's hawkish hits. He just came out, and the hawkish tone that he used once he thought that markets were going against what the Federal Reserve was trying to guide them to, I think it was pretty stark, strong, maybe even profound. Why isn't that an option he could take today? In the face of CPI that's coming in pretty hot, we've taken out cuts and this market's off to the races. Why wouldn't that be something he'd be concerned by?
I don't think it's a problem because I don't think he's trying to slow things down significantly. I mean, the unemployment rate has drifted up somewhat. We're still seeing rebalancing in job openings. The quits rate is coming down. Inflation is going down. The sequential numbers have been a little higher, but the year-on-year rate has continued to come down. I don't think he's going to be particularly worried about having to squeeze the economy. He can respond to surprises by delivering cuts a little bit later, delivering cuts a little bit earlier, but I don't think we're in a very different situation from where we were a year ago or
this is the change you've identified too, and it's implicit in your forecast, and you're right to point out that your growth forecasts have been above the street ever since you came out with your outlook. Strong growth doesn't appear to be a problem to the Federal Reserve. Why is that? What is different about this moment?
Well, because I think inflation is much lower and it's heading down, and the year-on-year rate is still heading down. The labor market is much closer to balance, so the inflation expectations have continued to come down. They've now largely normalized. So all the things that Fed officials were very worried about a year and a half ago, that you'd get anchoring of inflation expectations, you'd get a wage price spiral, I think a lot of those things have moved into the rearview mirror. And so therefore they are much less concerned about easier financial conditions. They'll still be relevant for setting policy, but they're going to be much less of a concern than maybe in this episode that you mentioned.
Jan, this was great. It's always fantastic to catch up, sir. It's been too long. It's good to see you.
Thank you.
Jan Hatzius there of Goldman Sachs.